Housing markets are flying right now, and I'm saying one of the reasons why is because people feel more certain than they typically do.
They're kind of close enough where people are like, oh, we might actually land this in a place where all of these indicators line up.
The importance of unemployment now is, I think it's going to rank the highest over the next 6 months.
We're not dealing with really, really big challenges and things that are way outside of where we want them to be.
Our unemployment rate might push up a bit more than we would want it to be for inflation to be in band. It's the economy that is driving the everything everywhere property boom right now. It's because we are currently in a situation where the economy is stable. There is little uncertainty right now. Certainty is exactly what investors, owner-occupiers, it's what everyone needs to feel confident. We are living in a time where there is more economic certainty right now than we've had for a long time. And that is driving the everything, everywhere property boom. In this episode, we're going to go through what is actually happening in the economy. Is this certainty going to last? And why are people feeling a lot more confident right now? Curtis, how are you, my man?
I like talking economics. This is exciting.
You are good at it. You are good at it. Ex-Treasury economist right here. I put on my LinkedIn title today, so I don't know why.
Aren't you an ex-Treasury economist?
I don't know. It sounds pretty cool. So
right.
Someone sent me a DM.
So is that two ex-Treasury economists then?
Yeah, cool. I don't know how they hired me though, but they actually hired you. They just made a mistake with me. I've said that out loud many times. So, Curtis, tell me, what is this certainty concept that I'm talking about? Because I think I'm talking about a theory, and you probably understand that because you've studied economics, but do you want to just unpack that for the audience a little bit? Like, housing markets are flying right now, and I'm saying one of the reasons why is because people feel more certain than they typically do, which is a bit weird given there's AI everywhere.
Yeah, you may have just invented your own theory there, but all right, sure. I think the certainty is coming from like a few key economic drivers, basically, or a few key economic statistics that everyone is always monitoring, like the RBA, everyone's looking at. And they're we're getting to a point now where these economic statistics are kind of in the window or close to the window where people want them to be for stability, like a stable inflation outlook, stable economic growth outlook, stable jobs market. They're not all there yet, but they're kind of close enough where people are like, oh, we might actually land this in a place where all of these indicators line up and we don't. Yeah. And like that narrow path that Philip Lowe flagged whenever it was many years ago, like we might be in that situation. So that's where it's like, okay, we're not dealing with really, really big challenges and things that are way outside of where we want them to be. We're starting to get into like the fine-tuning mode.
Yeah. I'd put this using your plane analogy that we've spoken about a couple of times. Our plane has flown through the turbulence, went through a storm, shaked around a little bit. It was just like, that was a bit scary. What's going on there? But now it's up there on cruise control. It's the pilot's, put on the get off your seatbelt badge. He's gone to the bathroom and he's just, hanging out for a little bit while the plane's just flying itself. That's making everyone on that plane feel pretty comfortable and, they're hanging out, having a joke, having a laugh, spending some dollars.
Yeah.
That's what's happening right now in the economy. It's just a general stable condition.
Yep.
Jobs are good. Unemployment numbers are, they're on the rise a little bit, but pretty good overall right now, at least in the data metrics.
Yep.
The economy is growing.
Thoughts on that, but yeah.
Real wages are increasing again. There's confidence levels are higher. Growth is positive enough. It's pretty inflation is exactly where it needs to be. Yep. Not below it, not above it, just where it needs to be. There's nothing really happening. It's like, it's on autopilot mode. That's where we're at. We've either landed the plane or we've gone straight back up and we're like, cool, it's all good now. That's how I feel on planes too. You know that.
You're normally much more stressed on planes. You're freaking out.
Yeah, I'm freaking out through the storm bit, being like, oh, my hand, Curtis, please. But once we're up there, it's just like, sweet. autopilot mode. That's kind of where we're at the moment. That's where the economy is at. Do you want to unpack why we're saying it's in autopilot mode a little bit?
Yeah, let's run through some of the stats. So, and I should say, if people want to do the nerdy bit and do your own research, the Statement of Monetary Policy from the RBA is a good home for a lot of these stats insights.
Yeah, no one's going to do that, but yes, go for it if you want to.
Hey, just throwing it out there, you can if you want. Okay, so now I assume no one's gone and done that.
Yeah, that's why they're listening to you. Yeah. You are the Statement of Monetary Policy man.
So let's break it down into a few of the different economic categories. So GDP, we've got 1.7% economic growth over the year to date for over the 12 months, I should say, to June 2025. So a little low, but positive. Previously, I think if you go back to these podcasts maybe 12 months ago, there was some concerns about, are we actually going to post some negative quarters of growth? We're hanging around 0, 0.1, 0.2 quarterly growth numbers that are very, very low. Not great. We want to be kind of above 2, but 1.7, close enough to that kind of fine tuning zone that you're it's not an emergency. It's a little low, but it's kind of in the window where you take it without too much of a fight. So quarterly growth still a little weak, 0.2. Household consumption rose only 0.3. So a bit soft, but there are enough green shoots that you're not stressing about it, I would think, if you're the RBA.
Yeah, I didn't say that. I'd say it's a little bit soft, but it's stable. It's stably a little bit soft.
Yeah, well, I guess it's been there for a while, and it's had some slight improvements.
Yep.
But it's not pinging around.
Maybe the confidence comes from
the stability.
Comes from the stability. I think people feel safe when things aren't shaking around. That's the general theory that I'm saying. But also there's probably an element of confidence where it's hey, we got a couple water pistols to throw at it. The cash rate's at 3.6.
Yeah, yeah, it's still restrictive, basically. Yeah.
There's plenty of we can throw in a little bit more momentum when we need to. And, that's kind of what the RBA has been doing. The RBA has began this year with 3 rate cuts, gave it a little bit of momentum. Now it's watch and wait, being let's see how it goes. And if it needs a little bit more of a push, we'll give it a little bit more of a push.
I think it almost certainly will. But you're doing it in a very slow, methodical way. It's not something that you're going there's an emergency, I need to really give this thing a kick along ASAP. It's more you can sit, watch, wait, and be yep, needs a little bit of a push.
Most rate cutting cycles don't. Most rate cutting
don't
cycles
work like that. Yeah.
It's this is just a gentle go, 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 go. It's the pilot going back onto the plane being let's step on the gas for a little bit.
Yeah.
And then keep going. That's kind of what the RBA is doing here. They're the pilot of the plane. And that's roughly the situation we're in right now. So that provides a little bit of comfort. I sit here a bit comfortably being hey, if it slows down anymore, the RBA is going to throw in another rate cut, another couple rate cuts, and house prices go up and we're busy again. That's kind of the rough frameworks for, how people feel right now in this economy we live in right now.
Yeah. So that's the economic growth side. In the employment market side, Statement of Monetary Policy has set it at 4.1. It's now at 4.2 in the most recent data, which employment growth has slowed a little bit. Job vacancies are down, although depending on where you look, I think job ads in Brisbane are up. But it's relatively stable. I think there's some underlying changes to the data, basically the participation rate is falling, which I think is supporting the headline number not rising that much, which isn't a very good thing for the economy because it means there's a segment of the population that were looking for work that were included in the unemployment numbers. And if they stop looking for work, then they magically drop off the data set. And the participation rate falling is an indication that that's happening, and that protects the headline number, but doesn't change the reality of maybe some underlying weakness there. I know it gets a lot of news, but a lot of the big banks and the financial sector have layoffs for, AI and tech related, change transformations that they're doing. So at the moment, it's pretty steady and it looks kind of okay, but my gut feel is there's a little bit of underlying softness there that's not in just a headline number of 4.2 or 4.1, or if it goes to 4.3. I think when you look under the hood of the labor market, it's maybe a little more sketchy than the headline says.
I 100% agree with that. On the ground, I think these numbers are sensing us into a little bit of a lull. It's like the boxer theory. Like, I feel like I'm in a boxing ring. I don't know why I keep giving theories in this episode, but like I'm a little boxer in a ring being like, ooh, I'm just dancing around, being like tiring the other person away, but like I'm about to get knocked out. Like I got like a sneaky little suspicion that plane is gonna feel some, storm on the horizon, or the iceberg is gonna be there. Those sort of equations are gonna happen right now, and like it feels a bit like that, but that's something that people aren't foreseeing that far into the future. They're just feeling what they feel right now.
Yes.
That's kind of our jobs a little bit, to be mindful of things that might happen and prepare for it. But in the job story alone, I want to focus this down to the housing market. There's a couple really interesting things here. Job ads in Queensland have jumped almost 12% in a single month, screaming out for workers. You're starting to see that in the house price story, and I've heard that a lot across different market points. And it's super interesting when you go into different locations and look at exactly where that employment growth story is, because Queensland's a big place, and regional Queensland is doing fairly well. And WA's unemployment rate is 3.5%, one of the lowest in the country, and it's got 3.5% jobs growth, employment growth, one of the highest in the country as well. So a very healthy jobs market in both of these markets, and that is driving the housing momentum right now. And the drop in listings as well is creating demand, supply imbalance, and price growth happening at rapid rates, which will continue for the next little period.
Yeah. So I think there are some green shoots as well. I just have a little bit of a question mark over the labor market data, basically, of like, it looks okay now. Definitely the RBA like to use whenever you read the like monetary policy decision statements and things like that, they, I think, gloss over it a little bit. They like to just throw the headline number out and be like, it's pretty good. Like, and we did some business liaison stuff. We walked outside onto Pitt Street and asked a couple of people and then went back inside, or some version of that. And like, look, it seems all right. But I think personally, I have a few more question marks around where that goes over the next 6 months. But for the time being, it is looking stable and adds to that kind of stability, the projection of stability.
100%. That economic story and the importance of unemployment now is, I think it's going to rank the highest over the next 6 months. If this unemployment trend goes up faster than what we think, so if we post 3 poor monthly job scorecards in a row, I think that will trigger the next round of rate cuts.
Yes, I agree with that. And like the RBA has a pretty broad mandate, but I think of the metrics, so if it's targeting, effectively unemployment, inflation, and GDP, of those three, because things are in a little bit more of a stable position, I feel like the RBA has a little bit more leeway to pull the trigger if it sees some unemployment numbers that it doesn't like. It can,
I hope they do,
with a bit more confidence, I think they can be like, hey, we can cut rates to support this. Like, that's our role in the Australian community, is to think about this. And we have a bit of confidence that we're not going to throw everything out of whack if we do it. I hope that's how it plays out, but I would think that stability gives them a bit more of a stable base to make those decisions from than having to, if that happened 3 months ago where the inflation numbers are still high but falling, I think they would be a bit more reluctant to be like, we've got none of the 3 categories where we want them, so like we don't really know what to do. Whereas if you got 2 of the 3 kind of under control, then I think there's a bit more freedom in decision making. But that's a bit speculative.
Do you think they'll be scarred by the recent inflation history? I would prefer if our central bank has a protection of jobs mandate right now, where it's just like, we fear, maybe through the liaison, we fear that our unemployment rate might push up a bit more than we would want it to be for inflation to be in band. If we fear that, my preference from the central bank is to not be conservative on rates. It's actually to be aggressive, to be like, let's throw in more momentum than we need, because we want to reduce the risk of that. That's how I feel that they should, make decisions in a situation like this. But, there's probably a level of bias there and a natural desire to protect as many jobs as possible in all economic environments. But do you think that the RBA is going to pick the recent history where it's just like, no, I'm not going to do that? Like inflation's just gone freaking gangbusters under our watch fairly recently. Like we got to make sure that inflation does not go higher than 3, and we got to do what we need to do to keep the economy on an even keel, and we'll react once the data tells us to react rather than be a little bit more preemptive and fearful about the downside risk to unemployment.
I hope your scenario is right, because that's what I would like to see as well. I would like to think that if you're sitting in the RBA offices, we're not talking about 75 bips of cuts that are going to come in overnight. It's hopefully going to be, we think employment's a little bit soft. We want to provide a bit of extra support. We're cutting by 25 bips. Like, I imagine that's the scenario. If you're at 3.6 and you're cutting by 25 bips, I would be hoping that the RBA is like, look, that's not going to move inflation out of the 2 to 3 band. Like, it's not big enough, and the lag time for it to happen, we still believe that the 3.6 is slightly restrictive. Like, if I cut by 25 bips, I should not be moving the inflation numbers that significantly. Yep. So I would hope that kind of reasoning allows them to be like, we want to give the employment side a little bit of support, and we can do it without making drastic changes to inflation. I would be very surprised if they think a 25 bip cut from where we are now is going to start an inflation spiral.
Yeah, for sure. I don't know what they think neutral is, but in my opinion, we should be currently, or by the end of the year, we should be at an interest rate level about 25 to 50 bips below neutral. That's where I think we should be. That isn't based on data, though. That's not based on our current data.
That's not going to happen.
Yeah, that's definitely not going to happen. Yeah. That's not going to happen at all. But the reason why I have that is because of the trend in unemployment, and the trend in inflation is kind of close enough to where we need it to be. But the trend in unemployment is something that I'm looking at. People are like, why would we not be in a position where we try and reverse that in a much simpler, quicker way when things are stable and comfortable? Wherever neutral is. So if neutral is 3.6 to them, I think they've said that current interest rates are restrictive. So
yes.
Maybe neutral is 3.1 to them. So what I'm saying is interest rates should be 25, 50 bips below neutral. It shouldn't even be at neutral. Neutral's the where it should be. I think they're getting to that. I think they're like, we're going to have interest rates at neutral.
Yeah, we're going to slowly get to neutral with 1.5 or 2, probably 2 rate cuts, I reckon. Yeah. I don't know what the NAIRU is.
Whatever they have their view of that is, that's kind of where I think it should be. But there's no real need to do it as well. Like it's pretty busy. And from our side, as mortgage brokers, BAs, whatever we're doing, it's busy. Two more rate cuts will be like, holy moly, we need to hire a lot more people quickly.
They'll play out slowly. And I think the stability argument, the stability position is, I think, quite important to the RBA as well. If I was Michelle Bullock, which I'm not, nor will I ever be, but if you were coming to me and being like, hey, I think we should be 50 bips below neutral because of XYZ reasons, I'd be like, oh my God, we just got it under control. Please get out of my office and come back to me in 6 months' time. Leave me alone. Don't give me the next problem. I just solved this problem. Chill out. I'll see you in January after the Christmas break. I imagine the attitude might be a little more like that to what you're suggesting.
They're definitely hesitant. They're definitely hesitant. So that's not how they view it. They definitely
we're in the little sail. Now I'm gonna have a crack at an analogy now. We're in the little boat, the little sailboat that goes up the river, and then we just got out of the rough waters, and now you're like, I want to jump up and down on this side of the boat. And can you just sit down and enjoy the smooth ride, please?
Jumping and down, up and down. Let's see what it's like on the other side of the boat. Yeah. Come on. But yeah, the reason for that is underlying it is the unemployment story. Yeah, it's an oil tanker. It takes time to move around, and interest rate cuts
concerns are too.
It's going to take a little bit of time.
Yeah.
But the underlying story of this episode and everything that we're sharing is the job story is fairly positive in Queensland and WA. Inflation is back under control. We've known that for a long period of time. The unemployment story is positive for long-term trends, and month to month it is a little bit patchy, but it's always been a little bit like that. We are in stable conditions, and that is promoting confidence, and that confidence is creating that everything, everywhere property boom right now. That is the story of Australia's economy right now, and that is the housing story too. They are coincided with each other. And that's why we've unpacked the economy right now. And we've got Curtis, the ex-Treasury economist, to unpack it all for us.